stocks.
And let's talk about the AI trade. I mean, recently we started to hear about Meta looking to Google. Nvidia sort of went out of favor for a few days. Then we saw a reversal. We were looking for Google 4 trillion, but you know, the AI race is on, and we still have guests who come on every day picking both Google and Nvidia. What are you hearing about those names and some of the other Mag 7 names?
I think the guests picking both stocks are probably the smart ones, because even if Google does better, Nvidia does better, it doesn't matter. If AI pays off the way that the bulls think it's going to pay off, both of those companies are going to do extremely well, and I think so will the shareholders. So the big scare was from Meta switching potentially to Google chips instead of Nvidia. And even if they do, I don't see them stopping completely with Nvidia. So I think both companies will still be winners. And the divergence we've seen in the stock prices, Google's gone up 20% in the last month, Nvidia's gone down about 8 to 10%. That's, I think, very much a near-term blip, because eventually those things will sort of collapse together again. Both will be running higher. We're not going to see this sustained K-shaped divergence for that much more.
Black Friday starts today. We're hearing a lot about record travelers for Thanksgiving. The projections for shopping over the Christmas holiday are up 3% roughly. Some say 4%. Santa Claus rally, is that still a thing in your mind?
So the Santa rally last week of the year plus the first 2 days of the new year, we average a 1.3% gain in the S&P 500 dating back several decades. If you annualize that, that would mean an S&P 500 annual return of 70% a year. So 1% doesn't sound like that much, but is actually very significant. And I think we have a 79% hit rate on that happening dating back to who knows how long, a very long way time before us. But I'm optimistic for the Santa rally. That's only going to add to all the tailwinds we just mentioned. So I think if we take a step back and say, are stocks higher from a year from now, I think it's a pretty easy answer, but let's see what happens.
Yeah, we'll see what happens. Also, we may hear who will be the Fed chair, even maybe by Christmas.
That's a huge tailwind.
Do you think that will be good news for the market?
It's very good news for asset holders, I would say, because if we get a new Fed chair before Christmas, which there's been reports we might get that, we're going to get someone that Trump is going to like, and they're going to compress interest rates to zero. And Trump has been calling for a 300 basis point cut for several months. We're not going to get that right away, but rates are going to come down much faster than people think. And I think right now we're at about 80% odds for a December cut. And if we get the new Fed chair within weeks of that, we're going to see multiple rate cuts in the new year. And again, when we're cutting into a non-recessionary environment, that is very bullish for stocks.
After Thanksgiving, major U.S. semiconductor stocks are expected to have a low-volume, quiet Friday session. Key moving averages continue to shape near-term resistance and dip buying possibilities for Nvidia, AMD, and Intel, all of which are still within familiar ranges. Since the Friday session will naturally take place the day after Thanksgiving, and many people just choose not to return to work, it appears like Nvidia will resume operations roughly where it left off on Friday. Thus, on Friday, there will be a problem with volume. There won't be any explosive moves, in my opinion. I might be mistaken. That can then be caused by volume. In actuality, though, we're staying within this same trading range right now. Remember that the ex-dividend date in this market is Thursday, which is also the dividend date. For Nvidia, that isn't a major motivator. Even though it's only a cent per share, there may be some sway. In the end, I believe we're still trapped at $170 to $200. Traders are taking Alphabet's recent surge as more than a one-time event, as it recorded one of its best weeks of the year, rising 6.77%, while the rest of the Mag 7 fell. The long-standing poster child of AI excitement, Nvidia, lost momentum once more as selling pressed due to concerns over valuations and escalating competition. In summary, the AI trade rotated this week rather than unwinding. Almost exactly. When Gemini 3.0 touched down on November 18th, it instantly raised the bar for Google's AI aspirations. The model's multimodal responses, leap in reasoning strength, and enormous 1 million token window provided traders with a concrete benchmark. In contrast to earlier debuts, Google immediately integrated it into search on day one, a display of confidence that the market obviously took note of. Additionally, the utilization numbers were helpful. With 650 million monthly users at the end of Q3, and queries that tripled from quarter to quarter, the Gemini app showed signs of genuine monetization traction. With tech titans like Mark Benioff describing the performance spike as the largest since the initial ChatGPT wave, traders quickly jumped on that tail. At this point, sentiment started to change. Nvidia's price is particularly vulnerable to reports that Meta is considering a multi-billion-dollar TPU adoption strategy, along with earlier indications that Anthropic is collaborating with Alphabet's hardware. Even a hint of genuine competition can cause traders to reconsider the setup when an asset is priced for perfection. Google's decision to expand the use of TPUs beyond internal use provides it a full-stack loop that connects chips, the cloud, and the consumer, something Nvidia cannot match. Traders reacted as though the AI space was finally opening up, while analysts noted it as a significant endorsement of Google's hardware approach. Despite the enormous numbers, a 62% increase in sales to $57 billion, the response was clear. No investors pursued. Even as Jensen Huang rejected claims of a bubble, selling were active because to worries about stretched valuations, cyclical AI investments, and focused demand. The notion that Nvidia still has more to show was reinforced by the stock's 10% decline this month and the leaning in of well-known bears like Ray Dalio and Michael Burry. Traders are skeptical of the price, not the company. The market reads that. With Alphabet priced at about 29.6 times earnings compared to Nvidia at 44.3x, buyers have greater leeway to defend increasing holdings. The belief that Alphabet is a value-tilted AI narrative rather than solely an AI growth story was further reinforced by Berkshire's $4.3 billion investment. Additionally, the monetization path appears cleaner than it has all year, as Google Cloud continues to grow at a rate of 34% annually as margins improve. For now, sentiment leans toward Alphabet. Analysts are hesitant about seeing Nvidia's retreat as automatic dip-buying territory, but they see opportunity for growth in TPU licensing and meta demand. As consumers look into other options, the market wants evidence that Nvidia can maintain its lead. While Nvidia tries to persuade the general public that its premium is still worthwhile, traders may continue to favor Alphabet into early 2026 if AI spending remains high and the company continues to demonstrate genuine monetization through search, cloud, and hardware. On November 19th, Nvidia revealed its fiscal 2026 third-quarter results for the 3 months that ended October 26th, allaying any worries about the state of the artificial intelligence (AI) sector. Since its graphics processing units, GPUs, and other products are essential components of the data center infrastructure required to execute AI workloads, Nvidia is a bellwether for AI. Therefore, at a time when worries that AI stocks are in a bubble have been mounting, the company's better-than-expected results were just what the AI sector needed. Here are some reasons why Nvidia's most recent quarterly report indicates that the expansion of the AI market is unlikely to slow down anytime soon. GPUs and rack-scale systems, which combine several GPUs, CPUs, memory chips, and cooling systems onto a single platform, are sold by Nvidia. In order to run AI models and inference applications, hyperscalers, cloud computing businesses, and AI companies deploy these processors and systems in large quantities in data centers. In the market for AI chips, Nvidia is by far the industry leader. Therefore, the impressive 66% year-over-year growth in its data center sales to a record $51.2 billion last quarter is evidence of the strong demand for AI chips. Additionally, all of its cloud GPUs are sold out, according to CEO Jensen Huang, indicating that the market for AI chips isn't likely to slow down anytime soon. Nvidia's sales increased by 62% to a record $57 billion as a result of the expansion of its data center business. At $30 per share, the company's non-GAAP earnings increased by 60% year-over-year. Analyst consensus estimates of $1.26's earnings per share on $55 billion in revenue were surpassed by the figures. Nvidia is selling hardware as quickly as it can be manufactured, so if supply limitations hadn't been a hindrance, its performance may have been better. Additionally, in order to fulfill demand for Blackwell, obtain long lead time components, and enable future architecture ramps, the business is strengthening its supply chain through orders. It's also crucial to remember that Nvidia's outlook bolsters the notion that its growth will continue unabated. The company's revenue expectation for the current quarter is $65 billion, a 65% increase over the same period last year. Furthermore, its target gross margin of 75% would represent a 150 basis point and 1.5 percentage point growth over the previous year. Stronger earnings growth should result from that. All of this indicates that in spite of its massive revenue base, Nvidia is on course to continue achieving exceptional growth rates. Furthermore, based on management's remarks on the most recent conference call, Nvidia appears to be on course to continue doing so for the foreseeable future. Nvidia CFO Colette Kress admitted during the earnings conference call that the company has received $500 billion in orders for 2025 and 2026 for both its next Rubin processors and its current generation of Blackwell processors. These orders totaling $150 billion have already been shipped by Nvidia. For the upcoming 5 quarters, it still has $350 billion in orders. This corresponds to a $70 billion quarterly run rate for data center revenue. Kress noted that the business is still getting more orders, though, pointing to its agreement with Saudi Arabia for between 400,000 and 600,000 GPUs as an example. For this reason, Kress stated that there is undoubtedly a chance for us to have more than the $500 billion that we previously announced. This indicates that Nvidia's data center business is expected to grow even more over the course of the next year or so, putting it in a better position to outperform its competitors. And for that same reason, the business is probably going to continue to be the greatest option for AI chips. Nvidia will stay far ahead of Advanced Micro Devices and Broadcom, 2 of its closest rivals in this market, if it manages to reach the $70 billion quarterly sales run rate in its data center business, as suggested by its backlog. AMD and Broadcom are not even close to the scale that Nvidia has attained, despite both companies anticipating impressive growth in their own data center operations, which are gaining pace due to improved sales of their AI chips. Furthermore, although growing at a significantly quicker rate than AMD or Broadcom, Nvidia's stock is currently trading at a lower price-to-earnings ratio. Given its dominance in the rapidly expanding AI chip market, which is expected to result in greater upside for investors, Nvidia is still the finest AI stock available today. Don't forget to share your thoughts and experiences in the comments below. Your input helps create a more knowledgeable community where we can all learn and grow together in the world of investing. Stay up to date with the latest market trends, insights, and key updates by subscribing to Investing Tutorial. We're here to help you make smarter investment decisions and stay ahead of the curve.
Sounds like you think the mid-month AI freakout may be behind us.
It looks that way. Listen, again, admittedly, there was a lot of nervousness about the amount of CapEx spending on the part of the large hyperscalers, but I keep coming back to the earnings reports themselves. You have, most recently, Nvidia, obviously the biggest and most important of all the names. Their report was quite good. You have all the derivative names underneath that. Christina brought up Vertiv, their report was quite strong, Amphenol, Eaton, et cetera. Any name even tangentially exposed to this idea was good. So I think you just had a moment where people decided to exercise some selling pressure, if you will. And to me, it was momentary. It's not emblematic of anything longer lasting.
All right, so what do you think dynamics change markedly after year end going into 26?
No, I don't think so. Obviously, we have had a market change here in terms of the Fed rate cut odds. They've gone from 20% to 80% now, mostly related to, obviously, New York Fed President John Williams' comments, and that's given a bit of a lift to the market. So you have the 2 pillars of the market, the 2 main pillars of the market right now working in your favor. The AI fundamental story still appears intact to me, and now you have, obviously, the prospect of a rate reduction in December, which is also a positive.
When you judge you said that if you look at the earnings themselves, the AI trade is still intact because the demand is still there and the capital spending is still there. But haven't we moved on to wondering if the payoff will be there, not just all of the capital spending? We know there's fundamentally tons of demand for NVIDIA chips and building data centers. That's what drove the first leg. The second leg, though, is the adoption by enterprise and by consumer and how fast that's coming and how profitable it'll be.
Yeah, that's a perfectly fair worry, as it might have been in the mid-90s with respect to the internet. I would just point to, we all joke about how many companies are mentioning AI on their conference calls, if only to check the box that they mentioned AI on their conference calls. But I read a bunch of conference calls, listened to a bunch where they talked about designing a marketing campaign, or Stephanie Link and I always talk about Facebook's report in terms of increased user interface with the Facebook suite of products related to AI. You're better able to curate your feeds, which keeps you spending more time, which is better for marketing. And that's all around the edges, obviously. But there was also a company that talked about designing a chemical product using proprietary corporate data and AI to design a brand new product. Now, obviously, these are, for lack of a better phrase, few and far between on the margins right now. But I think over time, that's going to start to come to fruition. Is it enough to justify all the spending that we're doing? Time's going to tell. But I do see evidence that this is starting to have an effect on productivity and product development.
Yeah, well, we're going to have to keep a close eye on that, because isn't it perfectly possible that we're going to have those kinds of moments where we start to question yet again whether all this capital is going to get a decent return? I mean, it's, we still don't know. It's mostly all on the come, Dan.
No, of course, it is all on the, and that's perfectly fair, David. But in media, since we're talking, we're starting to see the use of AI not just in script writing, but in on screen, whether it's special effects. There's a TV show, if you want to call it that, on the internet right now. I believe it's exclusively on Twitter. Don't quote me on that. Which is basically done all with AI animation generation. Obviously, a human wrote the story and instructed it, but AI has effectively generated that story. It's getting a bit of buzz right now for a number of reasons, some good, some bad. But the on the come, we are still early in this. Again, ChatGPT was just a few years ago. The release to the public was just a few years ago. I think it's going to take some time. And if we flash back, as I like to do in this particular show, to Books A Million and the early Amazon and Pets.com, et cetera, a lot of those didn't work out, but they did lay the groundwork for what eventually became quite substantial businesses in many respects. And I think that's probably going to be the same this time around.